Welcome to Next Gen Invest Global. Look, we're not just here to give you the headlines. We're here to connect the dots, to show you what the data says is coming next. Let's dive right in. All right, it is Monday, March 30th, 2026, and we're kicking things off today with a development that is already sending some serious ripples through the energy markets, and, it's reshaping geopolitical alliances as we speak. So here's the headline. This morning, the U.S. greenlit a Russian oil delivery to Cuba. Now, on the surface, okay, it looks like just an energy deal. But if you look a little closer, this is a perfect example of the major theme we're going to be digging into today. And that theme is divergence. This idea that old alliances, old policies, they're all starting to fracture. Right, so that big theme is divergence. For years, it felt like the world's central banks were all singing from the same hymn sheet. They all hiked rates together, and the market pretty much expected they'd all cut rates together. Well, the data is now telling us loud and clear that era of lockstep policy, it's over. And you can see that split right here, clear as day. On one side, you've got the U.S. Federal Reserve, and they're signaling, hey, we're getting ready to start cutting rates as inflation cools down. But then look at the other side. The European Central Bank, they're holding steady. They're worried about things like wage growth and inflation in the service sector. And then you've got the Bank of Japan doing something that seemed unthinkable for decades. They're actually hiking rates after all that time at zero. So what does this mean? It means each bank is now fighting its own local battle, and that creates a really challenging, really unpredictable environment for global capital. Now, speaking of the Fed's path, there's a pretty big disconnect we need to talk about. The market, it's pricing in maybe a couple of small cuts. But then you look at this forecast from Bloomberg Economics and whoa. They see the federal funds rate dropping all the way to 2.75% by the end of the year. That suggests a much more significant easing cycle could be on the horizon than what a lot of people are expecting. So, to understand why some folks are seeing a more aggressive path for the Fed, we've got to go inside their most recent meeting. Let's take a look at the actual data they're wrestling with. Okay, this quote right here from the March statement is absolutely key. The Fed is explicitly saying that what's happening in the Middle East, well, the implications for the U.S. economy are, and I quote, uncertain. They know that higher energy prices can fuel inflation, sure, but the overall economic impact, it's a massive question mark. And when you have that much uncertainty, it makes it so much harder for them to commit to any single policy path. And this data, this really shows the Fed's dilemma perfectly. I mean, look, their own projections have revised GDP growth upward to 2.4%. That points to a stronger economy. But at the same time, they've also bumped up their forecast for PCE inflation to 2.7%. And remember, PCE, that's personal consumption expenditures. That's the Fed's favorite inflation gauge. So you've got an economy that's running hotter, but inflation is running hotter too. It is a classic policy tightrope, and it really, really complicates any decision to cut rates. Which brings us to the famous, or maybe infamous, dot plot. It's simple, really. Each one of these dots represents a Fed official's best guess for where rates should be. Now, the median dot, the one in the middle, still points to one rate cut this year. But look at the spread. You've got some members who see no cuts at all, and others who are expecting several. That is the divergence we've been talking about, and it's happening right inside the Fed itself. So naturally, when you start connecting all these complex economic threads, it leads to questions about investing. And this is the perfect moment for us to be really clear. Everything we're discussing here, it's for informational purposes only. This briefing isn't investment advice. Any and all financial decisions you make should be with a professional advisor. All right, let's broaden our lens a little bit. That uncertainty we saw in the Fed's statement, it goes way beyond just oil prices. It connects to the changing nature of conflict itself, specifically the growing impact of what's called asymmetric warfare. And what is that? Well, it's basically conflict where a weaker player uses unconventional strategies, think low-cost tech, to exploit the vulnerabilities of a much stronger opponent. And believe me, it's a powerful force that is fundamentally reshaping geopolitical risk. Just think about this for a second. In Ukraine, 1 out of every 3 airborne targets is now being destroyed, not by some multi-million-dollar missile system, but by a low-cost interceptor drone. That single statistic right there represents a massive shift in both military and economic reality. And the economic math here is something that every investor really needs to get their head around. Look at these numbers. We're talking about a $3,000 to $5,000 interceptor drone, taking out an enemy drone that costs over $100,000. The old model, firing $1 million missile at a cheap threat, that's just not economically sustainable anymore. This new reality is completely rewriting the playbook for the entire defense sector. It's creating huge new opportunities in things like drone tech, cybersecurity, and counter-drone systems, while at the same time introducing this persistent, unpredictable risk that the markets are still trying to figure out how to price. Okay, so how do we connect all these different dots? We've talked about central bank divergence, we've talked about the economics of the battlefield. Let's put it all together and synthesize this data into a clear market outlook for the rest of the year. All right, let's boil this all down to 4 key takeaways. Number 1, global policies are diverging. That just means more volatility. 2, inflation is proving to be pretty stubborn, and that is complicating the Fed's job. 3, geopolitical risk isn't just high, its whole nature is changing. And all of this leads to the one single word that really defines today's market: uncertainty. The big challenge for investors right now isn't predicting one single outcome, it's about being prepared for many. And that leaves us with what might be the most important question of all. In a world that's fragmenting, where central banks are all going their separate ways, where new, totally unpredictable risks are popping up, where is capital going to flow next? Where will it go to find safety, and where will it go to find growth? That, right there, is the puzzle every single investor is trying to solve right now. To get the data-driven analysis you need to navigate what's coming next, make sure you are subscribed to @NextGenInvestGlobal. And hey, share this with someone you know who needs to see the bigger picture. We'll be back tomorrow with your next briefing.